meeting. Actually, I over panicked because I was thinking it was like the old days and town meeting week was crossover. We do have a week after that. I don't know what reason I'm having trouble getting bills in here.
So procrastination week? Is this procrastination week?
Yeah, well, the short is, I do have 2 weeks. I have a whole bunch of bills we need to get out, and I think some that haven't even come yet. And we have to have those out the week after town meeting, so take a look at the board, but I have, I think a bunch of them up there are revenue sources that I'm not gonna pull down unless we need to. Anything that requires a tax exemption, I'm gonna have to see what the revenues look like. There's just a lot of moving pieces, and I'm not sure where we're gonna get the money to fund everything that's out there, so I've kind of been collecting. But I think anything that has to do with taxes, in the end, we can put on miscellaneous tax, which will get us out. But we've got a few that have just come to us. And we're going to start today with the alternative minimum tax. And I've got Abby first. And this is not a bill?
Correct.
Okay, so another candidate for miscellaneous tax, or we could find a bill up there to stick it on.
Yeah, so Madam Chair, I just want to check on dates. It's my understanding that non-money committees have a March 17th date, but the money committees is the 24th.
We have the March 17th date to get all of the bills on our wall out. Then we have an extra week to do the bills that come to us from other committees. So we need to have our bills out by the 17th. We don't get special treatment unless we get special dispensation.
Okay, thank you.
So,
Anybody else's bills out?
So we procrastinate, most of us don't die.
you're right, and there is a reason to do that sometimes too. Okay, so we're going to talk about the alternative minimum tax. And Abby, talk to us about this.
Yes.
This is the governor's proposal. Okay, now my memory is clicking in and where this came from. I don't usually get a proposal for a tax without a bill number. All right.
So for the record, Abby Shepherd, Office of Legislative Counsel, I am going to be followed directly by the Joint Fiscal Office. So we're sort of tag teaming this. I'm going to sort of set up the legal background. I'd like to show you the actual statutory language. So you can see what
I'm going to let you continue. I left my iPad across the hall, so I'm going to go grab it so I can follow.
Just trying to make this as well. So as you'll see here, the alternative minimum tax is within the section that imposes the tax rates. It creates the brackets and then the actual income tax rates. And so once you have Vermont taxable income, these are the brackets that you look at for the amount of income and the rate. So I'm just scrolling through those, a little glitchy, sorry. There are lots of them. It's by each filing status. And then stop the, sorry, it's very glitchy. This subdivision A6 sets out an alternative minimum. And it states that if the federal gross income of the taxpayer exceeds $150,000, then the tax that is calculated in all those tables you just saw shall be either the greater of the tax calculated under those tables or 3% of the taxpayer's federal AGI. So that's the that's why it's called the alternative minimum. If someone's tax brackets and rate, what their tax liability is less than 3% of a taxpayer's federal AGI, and they have $150,000 of income, they will be subject to 3% on all of their AGI. So this is the alternative minimum. And that was enacted in 2015, and it has been in place since then. So, touch.
A question I will have, but I'm betting you're going to answer, is why 150,000? Whenever I see round numbers like that, it seems a bit arbitrary. I'd be curious how that number was come to and how long it's been then.
So it's been 150,000 since it was enacted in 2015. I do not have the history as to why, however, what the policy reason was behind that. To note, and I know that the Joint Fiscal Office has prepared a presentation to go into more detail about how this interacts with other deductions, and then this is a proposal from the administration, so they could speak to the policy reasons for they're keeping or repealing it. But one thing to note is that this was in 2015 prior to the Tax Cuts and Jobs Act changes, which have led to some of their policy discussions and reasoning for their proposal. Prior to the Tax Cuts and Jobs Act, Vermont had actually two different starting points for income. So it was originally federal taxable income until 2017. And in 2017, so the year that the Tax Cuts and Jobs Act was enacted, but it was actually prior to that, Vermont switched the starting point. There was a lot of discussion for several years about why is Vermont piggybacking off of federal taxable income? What about a move to federal AGI? I think that was a recommendation of the Blue Ribbon Tax Structure Tax Commission. And that gave Vermont more sort of discretion over what would flow through for taxable and non-taxable income. So that was in 2017. Then the Tax Cuts and Jobs Act made several changes, and those primarily most of those did not go through because Vermont was now AGI. So it's sort of higher up in it's a larger number rather than taxable income.
I remember it was to move, the Blue Ribbon Tax Commission had it moving to AGI, and the goal would be to reduce the topmost tax rate to 7.75%. And now we moved it.
And then in
And that's
2018,
exactly where it is, yeah.
correct. So the rates also were reduced in 2018.
Because we had gone to AGI the year before, we were in much better position when the tax cuts came. They were not.
Correct. So Vermont no longer has all of the federal itemized deductions flowing through, as well as personal exemptions, standard deductions. And because personal exemptions were changed, those were suspended under the Tax Cuts and Jobs Act, Vermont enacted their own, and as well the standard deductions. So Vermont has its own definitions. So Vermont has a lot more control than it did prior to 2017. I did want to point out some of the legal concerns as well with that definition for that tax base for the alternative minimum tax. So it could be considered constitutionally problematic because the tax base is AGI. Taxable income has subtractions and additions. Additionally, when calculating someone's tax liability, there is an adjustment for non-Vermont income. That's where you get the exclusion for any income that is not taxable by a state. So anything that's federally preempted, which includes railroad retirement income. So taxing AGI at 3%, and I think I mentioned that, but again, I just want to highlight the 3% is on all of AGI. It does not have the marginal rates and brackets. So that could be interpreted as problematic because it does include railroad retirement benefits. And I think that's sort of the lead into a lot of the discussion in the presentation that you'll have, both from a policy perspective and from JFO to show you how things flow through and the impact on taxpayers.
So this is, okay, I'll let the administration go over their proposal. This is the present law.
Yes.
It went in 2015, which I think is one of the years I wasn't here. Because this is not ringing any bells. You shouldn't. Yeah, at least just did something. Okay. And this is, I assume, in there to make sure everybody pays something.
Does it create a different tax rate on those individuals than they would otherwise be paying? So it would be, it's the greater of. So it's either under the tax rates and brackets or 3% on AGI.
Okay. Any questions for Abby?
Thank you, and I'll be sort of sitting on the sidelines.
And I've got a list on my agenda, but I don't know if that's the most logical way to go. This is what we have. I've got Emily and Ted next. You're going together, okay. 2 chairs. And then I've got Jake and Rebecca, but are you guys presenting the governor's proposal?
Yeah, Jake will present mostly, I'll be here.
Would it be more logical if they presented their proposal?
We talked to them and told them we're gonna go, we're gonna
Okay,
go first.
okay.
You guys
As
be
long
first.
as that works for all of
Yes,
you.
yes, yeah.
And you think it's logical, then we're good. Okay.
All right, so Emily Byrne from the Joint Fiscal Office, and
Ted Barnett from the Joint Fiscal Office.
we're just gonna do a high-level overview, similar to what Abby did, getting a little bit of numbers on the alternative minimum tax, just to kind of set the stage and some background, what kind of triggers it, and then have the administration do their. So Ted's gonna kick it off.
Sure, and what I'm going to say is going to sound very familiar. So starting on slide number 2, the current version of the alternative minimum tax was added by Act 7 of 2015. And what Abby was talking about, it was more relevant when it was created, largely because of the shift in 2017 to a definition of using federal AGI as opposed to taxable income. Moving on to slide 3. So talking about how who triggers the alternative minimum tax, it only applies on AGI over 150,000. The taxpayer either pays the greater amount of their tax liability based on their taxable income and the tax tables in brackets, or they pay 3% on all of AGI and there's no adjustment for marginal rates or different brackets. Because of the way Vermont treats certain deductions, they can occasionally drive a taxpayer's liability below 3% of AGI. And if the taxpayer has over $150,000 of AGI, they will owe on the alternative minimum tax.
Okay, so we let you, and I assume the one with the most emotional content is medical expenses. We let you deduct your medical expenses. And then if that gets you down below, so then we tax you a higher rate because, okay.
Sure.
I think that was the commissioner's presentation, that it was, but there are other things in there, like capital gains, okay.
And so this slide, on slide 4, is going to say a similar thing. Again, who's triggering it, AGI over 150,000. When you calculate your Vermont taxable income, you can end up with a tax liability below 3% of your AGI. And so there are 3 main deductions that are relevant to the alternative minimum tax. They're bonus depreciation, medical expenses, capital gains, and a few other items.
So this is just an example of a taxpayer, exactly, Senator Cummings, what you were alluding to. So on the left in blue, we calculate someone's Vermont income tax liability, so we're assuming they're sort of just over that $150,000 threshold. You know, after you calculate the medical deduction, so they can reduce their Vermont income tax, their Vermont income subject to tax by 25,000. Then they take the standard deduction, the personal exemption, to get their Vermont taxable income at about $103,000. So their taxes would be $3,679. So then you flip to do the alternative minimum calculation because their AGI is above 150. 3% of $150, $100 is larger than their taxes calculated based on Vermont taxable income. And because you're subject to the minimum, they end up paying more in taxes because they had that medical deduction at lower level.
But it would work the same if it was capital gain.
Yes, exactly. You could insert one of the other types of deductions in there.
But that, I think, is the one that had, yeah, medical deduction is a medical deduction. Okay.
So we thought we'd do just a little high level overview of those sort of three big ticket items that end up as subtractions from AGI that could put you in this situation where you trigger the alternative minimum tax. So the first one to go over you is just bonus depreciation. So this one is a little funky, but they're all a little funky. But so the Tax Cuts and Jobs Act increased the amount of bonus depreciation that an individual could take on their federal taxes from 50% of the capital outlay to 100% of the capital outlay in the first year.
Back to, what is bonus depreciation?
Bonus depreciation. So
Some of us don't get to take that.
yes, I'm going to do my best, and then I'm going to look at Abby and Rebecca to correct me. But if you own a business, for example, and you purchase a big piece of dairy equipment or something, or some
Okay,
big piece of
so it's
equipment.
not a bonus I'm giving my employees.
Yeah.
It's the extra depreciation. Okay.
Yes,
This is, okay,
you're allowed to depreciate it on your federal
income,
income tax.
all right. Yes.
Madam Chair, we're discussing the details of something if we laid out to amongst ourselves, so we understand what the purpose of a alternative minimum tax is, and when we discuss it, what are the principles that lines we will not cross when we're messing about and
Okay.
try to
I,
design one?
we will definitely have that, since I think perhaps Senator Brock was here on this committee. I think you were the only member present when this went into effect. So perhaps you, when we get to discussion, can lead us through what that thinking was.
I worry, because the public's listening in on
Okay.
the discussion we're having. And perhaps they would be interested in knowing what we're discussing and why, and what principles we might apply, and what commitments we might make to ourselves as we craft, endorse, recraft what we're discussing.
Right, and I assume that it was to make sure everyone paid their fair share and that those with high-skilled accountants didn't not pay and everyday Vermonters did, since that's frequently our motivation. But there's
And
been
I was
a,
not here, by the way.
You were not,
I was
okay.
Not here that day.
It was.
you were here, okay, good, so there's two of you. But there's been a lot of changes in the tax codes since then. This was prior to the Tax Cut and Jobs Act. It was prior to Vermont rewriting its code in response to the Tax Cut and Jobs Act. So we're listening to the proposal, we're listening to what's happening, and then we will discuss it, okay? All right, yes.
Just a quick question. So sometimes we talk about accelerated depreciation. Is this just another term for super accelerated depreciation, like 100% in year one?
Okay, this is super accelerated depreciation.
And so what happened at the federal level, they said you can take 100% of the cost of that capital outlay in year one. So what that does is lower your AGI in your federal AGI way down in that first year. Vermont, however, says you can't take the full value in the first year. There's a 5-year 20% deduction. So what ends up happening on the Vermont side is you add back 80% of the value of that asset in your calculation. And then for the next 4 years, you can deduct the remaining 20% equally each year.
So it's how quickly you conduct that actually business expense, right?
So what ends up happening in that first year is your federal AGI drops because of their capital outlay, and then your Vermont taxable income comes back up because of the 80% add back. And then you pay taxes based on the 80% add back. But then in year 2 through 4, your federal AGI doesn't have any deductions related to that capital outlay. So it is what it is. So it may cross that $150,000 threshold. Your Vermont taxable income, you've taken the 20% deduction for the next 4 years that you're allowed to take. And then you could, the sort of way that math may work out for an individual may mean that you trigger the alternative minimum. So you're paying, you add it back, you add back the 80% in the first year and you pay taxes based on that. But then you may trigger the alternative minimum in the next 4 years, which you're losing that deduction on your Vermont taxable
In
income.
essence, it's double taxation.
It's been thrown around, yeah.
Okay, but yeah,
Double taxation.
well, if you get to deduct 80, yeah. In the first year, if you take 20%, it comes off your Fed. But then your AGI is lower as you deduct it, because in the federal, you can take 100% your first year. So that really lowers it. We can only take 20, right, for 5 years. So if as they move up and down,
Yeah.
you could trigger having to pay an alternative minimum tax, which you wouldn't have had to pay, except that Vermont's lets you deduct it slower.
Right.
You've already.
Really
bought the
around those.
equipment.
It's around those margins.
Yes,
And so this is very complicated stuff, and our goal here is to tackle the problem that many citizens have of trying to understand why many large corporations don't pay a penny in taxes.
no, our goal is to listen and understand the governor's tax proposal.
Which is attempting to tackle the problem.
I will let the governor's
Okay.
representatives tell us what he is attempting to do. This has been a proposal, and we are going to give it a fair hearing, and then we'll discuss principles and goals on which we will make a decision. Without using pejorative terms, I'm not the only chair, I believe you told this morning we couldn't disparage other cities or.
It was getting a little bit much. All of a sudden, we didn't like Moscow or Hong Kong river boats or something.
We're living
what are we
on
doing?
boats if we put 40,000 units in downtown Montpelier.
But they were all lovely places to live for different people.
Yes. So anyway,
All right, so slide 8 really just tries to lay out what I just said. So this is putting it in words again. So I won't repeat it.
okay, send it to me.
So I definitely agree with Senator McDonald that talking about why we do these things. We talked about the alternative minimum tax, but for the Vermont requirement that we amortize on a straight line over 5 years, is that partly because the company, if they count the entire amount the first year, thus redoing their taxable income, and then sell it before the 5 years are done, then they receive a tax benefit without actually using the asset over the life of the gains? What is the rationale that you know of for the current Vermont rule of straight line depreciation?
I'm not sure what the current rationale is. I wasn't around.
You weren't here when we did. Catherine may be able to fill us in, or one of the members on the committee, but that was a while ago too.
We can see what we can dig up.
Okay. I think Catherine is probably the one who's here there.
Okay.
Steve Cohen's still on retainer, I'm sure. He remembers. Okay,
So a similar thing can happen with capital gains. So you can exclude a portion of your capital gains, of realized capital gains each year from your income tax. It's different from the federal law. So capital gains, right, are the profits associated from the sale of capital assets, stocks, business, real estate, or work of art. And in Vermont right now, you can exclude either $5,000 or less of adjusted net capital gains, short or longer term. And then there's also a 40% exclusion on specific types of assets, non-publicly traded businesses, farms, investment property, and timber, which is limited to either $350,000 or 40% of your Vermont taxable income. So it's the same situation when someone takes this capital gains exclusion, they can end up lowering the Vermont taxable liability to the point that they trigger the alternative minimum tax. And then we'll just repeat it again with the medical deduction. This went into effect in 2019. And going forward, created the new deduction for medical expenses. You can deduct the amount of your federal itemized medical expenses, but then minus the Vermont standard deduction and personal exemptions, and then this, the amount associated with monthly payments to continuing care facilities that are capped based on premiums paid for qualified long-term care insurance contracts. Same situation. You calculate your medical deduction. It drops your Vermont taxable income below the threshold, and you trigger the Vermont alternative minimum tax. 150. If you have 150,000 AGI. So that's in a nutshell of what's going on with the alternative minimum tax and that interaction.
questions at this point, committee? So,
What happens if you're on the minimum tax? You're paying less. So if you get down below that cutoff, that raises your taxes?
Yes, so if the amount of tax that you would have paid based on your Vermont taxable income, if you have $150,000 or more of AGI, if 3% of 150, whatever your AGI is larger than your Vermont tax liability, you pay whatever the larger number is. So
What am I, okay, as a layperson, that strikes me as regressive. Your tax goes up because your income went down.
your income, if you're,
there's two incomes. There's
Yes.
the AGI federal, and there's your Vermont taxable income. And so your Vermont taxable income cannot be what you would owe on your Vermont taxable income if you make $150,000 up cannot be less than 3% of your AGI. But if your AGI drops because the feds let you do different things than we do, then you will,
You lose that benefit.
you lose that benefit. And probably if you've got capital gains, you've made some money, so yeah. And if you've got bonus depreciation, you've got something you bought that hopefully is helping you do more with your business. But if you get a medical deduction, hopefully you get healthier, but you may not. And that is the one I think that seems most egregious, that if your medical expenses lowers your Vermont tax bill to below 3% of your federal AGI, you're going to have to pay that alternative minimum tax.
So we're not talking about your actual income getting lower. We're talking about the income that is identified and defined as.
Taxable or adjusted gross.
So that's why it's actually not regressive. Okay.
that's all we've got.
That's all you've got. Any questions? Don't leave.
We're not going anywhere.
we may have lots of questions. Okay, Jake is up there,
Yeah.
you're down here. There's Jake. Okay. It's your show, I don't know.
Yeah, well, Jake's really gonna do most of the presenting, but I'm happy to sit up here
Okay.
for.
It's a more comfortable
Yeah.
chair.
Oh, sorry. So sorry. That works? It's fine. Sorry. Rebecca Samaroff, Deputy Tax Commissioner for the record. I guess I'll just take the opportunity to say hi to all of you. I haven't been in here in person in years, but even in this committee remotely yet. So I'm great to see some familiar faces from other places, some familiar faces
And you
from
were with
here.
us for a while, and then you left for a while, and then you came back,
True.
so.
Always come back.
Yeah.
Yes, I've been at the department since 2013. I used to be in the data team with Jake, doing more of like fiscal analysis, economist type of work, and then have been in my role as deputy since 2020, end of 2020, I should say.
Perfect time.
Yeah.
Okay, Jake, you introduce yourself for the record.
Sure. Jake Feldman, Senior Fiscal Analyst at the Tax Department. Can you hear me okay?
That's
Now
better
we can.
now.
Yeah,
So I have been in your committee in person a few times this year. It's been great fun. I wish that I could be there in person today, but I have a cold, so I'm keeping some big distance and coming to you from my home. This is about the alternative minimum tax, and I'm going to try to answer a few of the questions that I heard in the past 10 minutes or so. The first one is that the proposal is a repeal of the alternative minimum tax. And this is on personal income tax, not corporate. Corporate has a whole different set of rules and set of rates
and we
and stuff.
just messed with those.
Yeah, so it's just personal income tax, and it's in a bill in Ways and Means H-153, along with some of the governor's other tax proposals. And we estimate the cost as about $500,000 a year, just for reference. And then a couple things about the history of this. So in 2015, which was around the time that Rebecca and I were starting, there was a need for some revenue. And the Blue Ribbon Tax Structure Commission's report had come out, I think in 2011, recommending that Vermont basically do away with itemized deductions. And at that time, Vermont allowed a lot of itemized deductions. So there was a bill that limited a lot of itemized deductions and put this alternative minimum tax in 2015. And so it was kind of like, trying to catch people who fell through because they had different kinds of subtractions available to them. And that was its purpose.
Package deal. You could go through all the having to itemize all your bills, all everything deductible. Or you could just pay this alternative minimum tax. Is that ringing a bell with me?
I didn't quite catch the end of that, but here's what I think. You're
Well, going through all the deductions is something of a hassle. You have to keep receipts, so it said, if you don't want to do that, you could pay the alternative minimum, but it was part of shrinking that.
It was a package, but it was less of an election between the two, and there were both like these limitations on the itemized deductions, and then this kind of like gross limitation over how low your taxable income could go, were paired together in a bill. It's like double protections, I guess, to make sure folks weren't, as Jake said, just like reducing their income so low that it felt like it
They didn't go any,
it reached some level that didn't feel right.
And the Blue Ribbon Tax Commission number 1, looked around and said, very few of our neighboring states allowed anywhere near the deduction. I think Massachusetts said you can take a standard deduction of X percent. There were a couple that did that, but that we, by and large, had the most complicated, depending on where you fell in the order, was X percent a better deduction. Some had no deductions. And so that was where this came from, the looking at our deductions. And it was, I think, trying to simplify the tax code at that point.
Well, I was trying to make it more fair. It was trying to make it so that people weren't sort of slipping through the holes in the Swiss cheese, basically. And at the federal level, there's been an alternative minimum tax for a long time. But at the federal level, it's some serious Swiss cheese with a lot of different holes. So before 2018, Vermont had a few of these holes, and in 2015, it sort of plugged them up, but it also put this as an absolute backstop. If you somehow are paying less than 3% of your AGI and your AGI is over 150,000, we're gonna make you pay 3% of your AGI. However, in 2018, in response to the Tax Cuts and Jobs Act, the tax department designed a pretty massive reform to our personal income tax, which got rid of all the itemized deductions. It was consistent with the Rim and Tax Commission's report, and so there were very few holes left. In fact, in 2018, there was no medical expense deduction at all because there were no itemized deductions. And if you guys could take a look at one of the handouts that I have, it's called 2018 to 2021 summary on your website.
On our website, okay. We'll get it.
I think it's under.
So what this is just us taking a look at, so what is triggering the alternative minimum tax for people after 2018 when there's so few holes left? And in 2018, there was no medical expense deduction, and the Vermont AMT was only raising $83,000. And that's that first table. You had bonus depreciation, which JFO talked about a little bit, and I'll talk about a little bit more. And then, roughly half capital gains and a little bit of this other thing called bond note interest, which is if you get interest from a few different kinds of Vermont specific bonds, that income is deductible. So my point is this, in 2018, it didn't raise much money. In 2019, medical expenses came back on the scene. Vermont reintroduced medical expenses because some people, were upset that it had been eliminated.
You missed it.
Pardon?
Literally, we totally focused on charitable deductions because there were a huge number of charities that were very concerned, and they filled this room, and for some reason, the medical expense people, maybe because they were sick, didn't, and we just plain missed it and came back to fix it the next year.
Right, yes. Yeah, that's how I remember it too, Senator. The charities were on top of things in 2018, but you're right. So medical expenses comes back into the Vermont code as a deduction in 2019, and consequently, Vermont's alternative minimum tax starts making money again. Now it's raising $400,000 of revenue. The majority of that is from people who have medical expenses, and about a third is bonus depreciation, and capital gains is, not much at all. 2020 looks really similar. It's coming from medical expenses. Capital gains, again, under 10%. And then this thing called bonus depreciation, which as you aptly identified, is a situation of double tax in Vermont. That's 20%. And then 2021 was a especially good year for capital gains, and it went up to 17%, but the other things were still dwarfing it. So my point is that it's mostly a tax on medical expenses. The
Okay.
very bottom table, sure, go ahead.
No, that's fine.
Okay, the very bottom table is answering the question, so who pays the alternative minimum tax in Vermont? Is it the very high income people or something else? And I broke it out, not including 2018, because there was no medical expenses in that one, and it wasn't a big year for the alternative minimum tax. But looking at the next 3 years, I grouped them by their income band, by AGI. And it's filers who earn between 150,000 and 250,000 are the majority of those who are paying the AMT, and they're paying more than 2/3 of the tax. And then the amounts decrease as you go higher in income.
150 to 250 paying 67% of the tax. And if we combine that, the majority of people paying the tax are doing it because the medical expenses lowered their taxable, their Vermont taxes below 3% of the federal AGI. So we are hitting, when we put medical expenses back in after all the changes in the feds, we had a decided jump in revenue, but it was coming, the bulk of it, over half was coming from people who were deducting medical expenses off their income. Doctor's bills, nursing home bills, yeah.
This brings me back to the 150. I mean, why was 150 chosen? Why not raise this to 250? And then are we still achieving the same thing with having an alternative minimum tax or some other number with more rational backing?
Well, I think this is saying do away with the alternative minimum tax is the proposal.
But that's, that's a key feature of the inequity that's baked into this too, because that 150 doesn't change if you're a single filer, if you're a joint filer, it's a lot of, I don't know, to summarize what I look at when I see Jake's data here, which is really compelling to me, is that, this piece of our tax code used to be in place to be like a safety net, a reverse safety net, to make sure no one was, not paying a fair share. But these days, when we've already done such a good job of closing those cheese holes in our tax code, bad play on the analogy. We've done such a good job at that now that the folks remaining, which is literally a handful of folks, we're talking like 200 to 300 people a year, are just finding themselves triggering this because of just, very specific, alchemy of income that just, puts them right in this window. It's like very specific and arbitrary, to use your word, in some cases, and then it's like way too broad in other cases. Like, why would it be 150 for a single person and a joint filer? And just with the small, whenever you see just such a small number of taxpayers hit by something, when it's like not predictable very much, this is just like a strange assortment of income that puts these 200 to 300 taxpayers in this situation. It really like raises our red flags at the department. Like, do we have an equity concern here? Is this really good tax policy?
Right. And to add to Deputy Commissioner Samaroff's point, the reason that we're here presenting this is because we've been, approached by tax preparers and individuals saying, what's the deal with this? Like, I had this major medical event, my family had this medical event, and I'm, experiencing this tax. So that is what brings us here.
And the hard part about examples like that is because these deductions are allowed at the federal level, someone might have, their federal tax liability is very low, but all of a sudden they're hit with a large Vermont tax bill because of those same medical expenses in that example, but maybe because of, one of these other income items in another example.
Okay.
So I have a couple examples that just kind of, put a face on this situation. It's there again, it's under my name on your website. I think it's called AMT examples. The first one is about medical expenses. And I have a couple here, a married couple, Jim and Jane. They've worked for state of Vermont for 15 years, and they have a combined income of $160,000. Their teenage son had a bad snowboarding accident this past year, and some of the medical expenses that the family incurred were not covered by insurance, and it cost them $100,000 out of pocket. So their AGI is 160, so they're up in that, potential AMT zone. And if there was no AMT, that second line is what their Vermont tax would be. It would be 1,121. But there is a Vermont AMT. So they have to pay 3% of 160, which is 4,800. So the state is experiencing, about $3,679 of revenue from that tax filer.
Okay, plus they had to pay the $100,000 in medical bills. So they are, the other two you can argue, well, they made some money, but this one, they just paid money, but because that really essential to life payment expense, they're getting doubly nailed. They're paying the medical expense, which is money out the door. Plus, then we're raising their taxes because their kid had a snowmobiling accident. So there's a real feel of injustice there, at least for me.
Yeah, for me, it's like, it's odd that you'd give somebody this deduction and then essentially take it away 3 lines later on the form. If you don't like the deduction, then do something about the deduction, but don't take it away. Just, you know what I mean? So that's a medical expense example, and similar to the one JFO showed, but a little bit more of a tax impact. Bonus depreciation, it's like, when you have a business and you buy a piece of equipment and you put it into service, you can deduct the full cost of the piece of equipment in that first year. That change came about in Tax Cuts and Jobs Act. Before that, it was 50% in the first year, and then maybe 12.5% after that for 4 years. But Tax Cuts and Jobs Act accelerated it. And Vermont stuck with straight line 20% per year for 5 years. So in year one, you have to add back the difference. So it's kind of like you get taxed on that 80%. But in the subsequent years after year one, you get to subtract 20% of the cost of the piece of the equipment. So it's just like a different way of handling it, which is not necessarily bad. But the problem is when it interacts with another part of your tax code, in this case, the AMT. So I have this example here that Kate and Ken and their 2 kids have been running a successful Northeast Kingdom organic dairy farm, but faced with the loss of their regional milk buyer in 2021, they decided to try to start bottling and selling their own milk. To help facilitate that transition, they spent $200,000 on some sort of automated milk bottling line equipment. In tax year 21, they added back $160,000 of bonus depreciation when calculating their Vermont taxable income, because that is 80% of 200,000. which made them pay an extra $10,000 in Vermont income tax. But starting with the taxes they're filing right now for 2022, they're supposed to get to subtract $40,000 each year. I set this couple's AGI at exactly $150,001. And you're probably thinking, oh, that's not fair. Like that's $1 over the limit. But my point of that is that it's when you have a situation in your tax code where a $1 change creates a major difference in your taxing regime, that's problematic. And that's not equitable because people who have tax preparers can figure that out and people who don't can't. So it's very awkward among the other evidence, that we're presenting today to have a stark cutoff in the way you tax people at a certain dollar amount. So in 2022, their Vermont income tax without the AMT would have been $29.21. The next line, I didn't update the year, sorry about that, but their income tax with the AMT for 2022 is $4,500. So the revenue to the state is $1,579. And if their AGI goes on at the same amount in the next 3 years, they're still not going to get their 20% subtraction. So it's like, it just cuts them off for the next, for all of it.
They're really kind of buying new equipment and trying to stay in business. I mean, they're ending up paying more tax.
This one feels particularly unfair because it's not, there's like a very intentional policy decision in another part of the tax code that allows for this depreciation, but just allows for you to take 20% reasonably over the course of 5 years. But then just because the AMT gets triggered, which I don't think, the folks that decided to decouple from federal depreciation, I don't think that was part of the plan. All of a sudden you can't actually continue to deduct those 20% in the out years. And we've already made you add it back in the first year. And that's why, if anything, it like definitely, has the feeling of double taxation, if not just being double taxation. But don't want to, die on the term, but, they've added it back in year one and then we don't have to deduct it
There's a sense of
afterwards.
unfairness
Yeah.
here, that we give you a depreciation with one hand, and then we essentially take away the benefit of that depreciation with the other hand, because
Yeah, and even more, aggressively, we make you add it back in that first year, with the understanding that, you'll get deducted the next.
the next few years. Okay. Questions for Jake at this point, Rebecca? Okay.
This is maybe a broader question. Or is this coming with a proposal to just get rid of it, or to look at each one of these deductions individually and say, is this working for this type of deduction and not this type of deduction?
The proposal that I just wanted to clarify, this started as a tax technical proposal. As Jake said, we've just heard, a lot of anecdotes from preparers that we found pretty, troubling, and I wanted to at least, bring it to this legislative body to answer if that's intentional or not. We would recommend a full repeal because as they're like these three examples of the major reasons why folks are hitting this, are things that can be explored independently, but there are intentional policy decisions made around each one. Like capital gains is limited in two ways, as Emily and Ted described. Bonus depreciation we've decoupled from the feds, but it's on a schedule with a clear policy. There are opportunities to address those issues directly, but just having this, this blanket that affects 200 to 300 people in vastly different circumstances in this way seems blunt.
We had reason to do every one of those things. What we're seeing now is there's an interaction in the tax code that may not be what we intended. And I found out today there is a House bill And I didn't know that, so I didn't hear Money Chairs if it was making any progress.
Our appeal language is in H 153, which was kind of the bill that held all of our tax technical and then also some of the.
Miscellaneous
Yes,
tax.
it might just become the miscellaneous tax bill.
Okay, but we don't have to act on that.
I'm not sure if that bill is, I'm not sure what the status of that bill is, but the language is in it.
Things like the yield usually go in there, so that one is usually the last one to come over. But I can't remember it ever not coming out. It's the technical changes, but it's also where, because it's changes to the tax code, it's a pretty broad germane.
I'm right. I reported technical tax one year and it became the bill for everything at the end.
That's right.
Everybody's-
You may be
Yours
sorry,
is
for
Yeah.
housing on your bill before it
It
gets
was
out.
way above my pay grade.
So I'm not sure if this language will end up in the miscellaneous tax bill as it's, because it has that $500,000 price tag on it, it's not really considered technical, even though, it came to us in the same way that our technical proposals do. So, yeah, so I'm not sure where.
$500,000 this year, that's decimal done.
It's a great year to
The
consider.
numbers that are being thrown around, unfortunately, the numbers that are being thrown around require more revenue. And so it gets really hard to give up revenue we've got. But
It is in the governor's budget.
it is in the governor's budget. And
Error?
Pierre?
Was it an error that it's in the government?
No. This was a compelling technical proposal to the administration as well.
we know that that will get worked, both in the House and in the Senate, so. But this is a good reason to know this. I will check with the House to see what progress they're making. I know they're working on a couple of other bills to get out to get over here. So I'm assuming that miscellaneous tax is coming because it always does. I don't know if this will be on it.
Yeah, I'm not sure.
Yeah, because that doesn't usually go to the probes.
Yeah, that one generally doesn't have the items with budget impact, at first at least. Who knows where, what happens to it.
Okay. Any questions? Okay. It's my agenda again. We are actually, we have about a 10-minute break. And then we're gonna come back with elective pass-through entity income tax and credits. These are all bills that are up there. We are going to have to start figuring out what are must-dos and what we really want to get out of here. I'd love to have those start going out next week. And then just get them moving.